So, let's begin. In terms of accounting for uncollectibles, there are two distinct ways that we could account for uncollectibles. Two distinct ways to account for uncollectibles, two different methods. The first method is called the allowance method. And the next method is called a direct write-off method. The first method is called the allowance method. The next method is called the direct write-off method. And those are the two methods that you can account for when you're dealing with uncollectibles. So, let's talk about the allowance method. The allowance method, in a one-word description, estimates. The allowance method estimates. So what does the allowance method estimate? It estimates the amount that they're not going to collect, the amount that you're not going to collect. So under the allowance method, you sell a product or you provide a service. But at the end of the year, when it's time to make an adjusted entry, remember we talked about adjusted entries, you're going to estimate a certain amount that you're not going to collect from your customers. And so that's what the allowance method does. You sell on an account, and based on your past experience with customers, you estimate a portion that you probably won't receive. Okay? The direct write-off method, it doesn't estimate. Basically, you sell a product, you provide the service, you wait, and the moment that you realize that it's uncollectible, you're going to do what? Directly write it off. So one, you kind of plan ahead and you account for it accordingly by estimating. But two, on the other end, you just wait, and then you make the actual write-off of the account. Okay? So we're going to deal with this allowance method for right now, then we'll move to the direct write-off. The allowance method estimates, as I said, and they estimate in two ways. There's two ways that you can actually estimate, two calculation ways that you can estimate. One is called percentage of sales, and the other is called percentage of receivables. One is called percentage of sales, and the other is called percentage of receivables. And so let's go into how we're going to handle accounting for uncollectibles under the allowance method. We're talking about the allowance method. Basically, your allowance method has three journal entries that you have to be aware of. And so I'm going to just share with you the template of the journal entries, and I'm going to explain them, and you can just memorize and or understand them so you can be able to apply them to your homework. So the first one is going to be the estimate, of course, obviously, because we understand that that's one of the significant factors of the allowance method. It estimates. And so we know upon us actually providing a service or selling a product, we know how to make that journal entry on our account. We always debit accounts receivable. We always credit sales or service revenue. So that's good. But when it's time to make the estimate under the allowance method, we have to know how to make the journal entry. Anytime that you make an estimate under the allowance method, two things are going to occur. You're going to create an expense, and you're going to affect accounts receivable. Think about that. You're going to create an expense, and you're going to affect accounts receivable. Now, how are we going to create the expense? Anytime that you estimate, you have to debit bad debt expense. When you can't collect from a customer, it's an expense to the company. So you debit always bad debt expense. Some people call it uncollectible account expense, but for right now we're going to call it bad debt expense. And you we also credit allowance for uncollectible account. So your estimate journal entry will always be under the allowance method, a debit to bad debt expense, a credit to allowance for uncollectible account. We know bad debt expense, last name is expense, so this belongs on the income statement. And we need to know what this is. Allowance for uncollectible account is a contra account. We know what contra accounts do because we've seen them a couple of times. They affect other accounts. This allowance for uncollectible account is obviously a contra account that's going to affect what account? Accounts receivable. How is it going to affect accounts receivable? Think about it. We're estimating that we're not going to collect. So this is the portion of it that we're not going to collect. So actually we should be doing what to accounts receivable through this account? Decreasing it. So it's a contra account to accounts receivable. And we already know that these contra accounts follow the account that they're affecting. So we realize that this contra account is going to be on which financial statement? The balance sheet. And where is it going to go? Right underneath accounts receivable. And what is it going to do? Subtract it. Okay? So this is your estimate. Now once you estimate and you put that on the books, everything is cool. Now you're just waiting. It's a waiting game. So you're going to wait, you're going to wait, you're going to wait, and you're going to try to collect. If you don't collect, then you realize that, hey, this person isn't paying. Then you go to the next step. The next step is actually making a write-off. And when we say write-off, it basically means write off the account from the books. What writing off the account from the books means is actually just removing everything that is related to that particular person off the books like they don't exist. Okay? And so whenever you have a write-off, you remove everything from accounts receivable. Everything that affects accounts receivable when you have a write-off under the allowance method. So what account's going to be affected? Obviously accounts receivable and obviously the contra account. This baby that files it, right? So both of those have to come off the books. So we're talking about a write-off here. And so to put allowance on the books, we credit it. So to remove it, we need to do what? Debit it. And I'm going to shorthand and just say UA. Right? Allowance for UA. But I'm talking about uncollectible account. And so what do we have to credit? Accounts receivable. Why? Because to increase accounts receivable, we debit it. But to take it off the books, we credit it. So we have to take it off the books. So we're going to credit accounts receivable. Okay? And so that's simply a journal entry for the write-off. Very easy. Last journal entry that you may possibly encounter. So now we've written it off. So the guy no longer exists. We're not worried about collecting from him. It's a dead deal, right? What do you think will probably happen next week? Of course, right? He's going to go ahead and pay for it. Okay? And so what happens when you have to collect from an account that's already written off? How do you go by handling that? A collection from account previously written off. A collection from an account previously written off. How do we address that? Well, it's a two-step process. First, you reverse the write-off entry. You flip the write-off entry, and then you record it as a normal collection on an account. So flipping the write-off entry will require us to debit what? Accounts receivable. And credit what? Allowance for uncollectible account, whatever the amount may be. Okay? Then we would have to go to the second step, which means record it as a normal collection. So we know how to collect on our account. We debit cash, and we credit accounts receivable. Voila. Okay? So this would be an example of each component of the allowance method. So understand that you start off with an estimate, and then eventually you write off the account, and then there's a possibility that you may collect from that account previously written off. Understand those journal entries, and you should be good to go. The next video is going to talk about how to calculate your estimate. Because remember what we said, there are two ways to calculate the estimate. In terms of these particular journal entries, the numbers will always be given to you. So you just plug them in. Make sure you understand the journal entry. But I'm going to talk to you guys about how to calculate your estimate.